Hey guys, what's happening? Welcome to Wealth Circuit Investing Live. I put this new little banner in there. Hope you like that. But anyway, we're here to talk about investing and things like that. But before we kind of get started in that, I just wanted to say it kind of sucks to start getting older. And remember, I don't say I'm old. I'm just getting older. But I was carrying, or I was. You guys don't care about this, but I was loading some empty trash cans, the big kind, in the back of my pickup truck, and I was pulling one of them out, and man, I messed something up in my elbow here. Come to find out, it's tennis elbow, but and I never play tennis, so I'm not sure how I got tennis elbow, but it is really, really painful. So I've ordered this little thing that goes around the arm, the forearm. And so when the person told me about it, I was like, yeah, right. My pain is not here. It's here. It's in the elbow. And they're like, yeah, I know. But when you put pressure on this, it doesn't hurt anymore. And they were right. I was like, dude, so I've got those ordered from Amazon and looking forward to getting those in because it's hard to pick up anything. It's hard to, untwist the top of a water bottle. So it sucks getting old. But you know what? When we invest, when we save, invest, do the right things, manage our budget as we're younger, raising our families, you get to the place where you can enjoy the older years, that you're not having to work when you don't want to. So that's kind of what we're here about. We're here about investing. We're here about building our wealth so that we can do what we want to do when we want to do it. And we're not so tied into what other people want from us, from a job, for instance. So that's where I am, and I am loving every minute of it. So with that, I'm going to take this little thing off here. I was playing around with this a little earlier. There we go. How's that? Hey, you guys want to see this cool little thing? Check this out. There we go. It's up in the right-hand corner. But I'm going to take that down because we're going to need that space here in a little bit because we are going to talk about some heady stuff tonight. We're going to get into a question that I got on the Discord. If you're not part of the Discord, I invite you to follow the link in this video to the Discord. It's free to join, and we talk about stocks, and we don't always agree, and that's okay because that's what makes us better. Iron sharpens iron when it comes to investing. So, it's always good to have some dissenting views because it makes us really think about what we're wanting to do. And so if that's the community that you want to be a part of, if you want to have a little bit of accountability and you want to share some things that you're thinking about, you don't have to share your portfolio or anything, but just say, hey, I'm thinking about buying X. What do you guys think about that? Or, I'm thinking about selling X. What do you think about that? So there's just a lot of good conversation that we get to have in there. And one of the channels inside the Discord is called Questions for Kevin, Kwestion, Questions for Kevin. And we got a good one this week. So I think we will spend a little time on that. I've got some slides put together for that, but it's not an easy, it's not a simple question. It's really more complicated. And, I've had to pull from my expertise in corporate America, my expertise from the master's or MBA program, my expertise from investing and, investment committee type activities to kind of pull this together. So I'm excited about what I'm going to share with you guys tonight. And hopefully you'll find it helpful in your investing journey because that's why we're here. We're here to kind of build our investing journeys together. So with that, let me kind of see who is on the program tonight. So we'll kick it off here. Michael Swami. Michael was first off. He was 30 minutes early. Michael, it's good to see you, buddy. John J. is here, and his question is, buy companies with good debt. So does that mean that there's companies that have bad debt? That's I don't know. We'll talk about that here in a few minutes. Run DMS is on the program. Good to see you, buddy. Pat is here. Pat, when are you going to be heading out? Maybe after Christmas to warmer weather? Interested to hear about that. Fast Eddie is here. Good to see you, man. Kevin Mendoza. We do have two Kevins now. So one more and we will have a quorum. So that way, whatever Kevin's say kind of go, because we have a quorum of Kevin's. John J says tennis elbow or metal can elbow. Order Dr. Ho, might help with muscles. I'll have to look that up. I don't know what that is. So, but yeah, it's actually one of those big square plastic ones that have the wheels on them, that you can kind of lean back and roll. So, they were not full. They had already been emptied. I'd taken them down and they had already been emptied. And so, I don't know. This sucks getting old. So we got El Dynamico just passing through today. Just stopping by to leave a light on your channel. Have a great week. I appreciate that, my friend. Good to see you. And I hope all is well with you out in the California area. Bernard's here. Good to see you, my friend. How is West Sacramento? Yeah, that's a good question. I'm not really sure. Tim McCarthy is here. What do you think about Civi? I'll have to look that up. I will make a note of that. And it's funny. My phone lit up and I didn't know why. And when I said Civi, it thought I said Siri. So we'll have to look that up. I will write that down and we'll come back to that here in a little bit. There's also something else I want to share with you guys tonight. And that is, some changes I made to the portfolio today. I did not post those out in the Discord, and the reason is I wanted to talk about them here. So I made a couple of transactions today, and I wanted to talk about what that is. I'll give you this hint. I sold out of one stock, and I sold some shares of another stock. And I bet you cannot guess which stock I sold out of today. So, but then when you hear why I did it, it'll probably make a lot more sense. Has nothing to do with the stocks. So, so we'll talk about that as well. So Michael says Michael says he sold Intel and bought ADP as its replacement. I think, first of all, the selling of Intel is a great move. I think I just don't see any near-term strategy for them to kind of, make their place in the world. They're going to need some time and a lot of capital and a lot of expertise, good management, good strategy to kind of make a name for themselves again. So I think selling Intel is the right move. ADP, Automated Data Processing, I think is a fine company. I've looked at it myself. Where's it at? I don't know. Do I track it? Let me see. Dun, 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 dun. I'm looking at my list of stocks, and I do track it. So let me kind of see where it is. Trying to think of how to do this easily without boring you guys to tears. I don't want to share this yet because there's some stuff we're going to look at a little bit later, and I would give some things away. We wouldn't want that, would we? Automated data processing. I know what I can do. ADP. There it is. Yeah, it's number 34 on the list of stocks. Number 34 out of my 92 or so that I track. So, it's not a bad holding. And the analysts think that there's going to be about a 4% total return over the next year. I'm saying it's more like an 11%. So, it's not bad. I think it's got its challenges, as all stocks do. Any company's got its challenges, but I think they are prepared to handle those. So I think that's a good move. So good moves, man. Yeah, absolutely, man. I will take a look at that. Civi, no problem. And if I don't put hey in front of it, I think my phone's okay with it. Hola to Steve. ¿Cómo estás, amigo? Billy, good morning, my friend, over in the Philippines. Good to see you. Have you combed your hair this morning? Have you had a shower? I'm not really sure what time it is over there, but I appreciate you joining us in the early morning hours. Oh, you want to look at AES? Okay, I will do that too. I'll put that on the list. And love to do this kind of stuff. This is kind of what gives me my, my energy, my the things that kind of help me wake up in the morning. So Michael says Siri does not speak Southern. Well, actually, mine does. She knows that hey has 2 syllables to it. It's hey, hey. So anyway, she's got me figured out, I think. West Sacramento will be 33 degrees. Wow. That's I'm not sure what our temperatures are going to be, but it's gotten chilly. It has been down in the 20s here. But it's been a little bit warmer the last day or so. So that's pretty chilly, El Dynamico. Kenji's in the house. Honeybee is guessing Hershey. And that is a good guess, but is not the correct one. We're going to talk about Hershey here. I think I'm going to go ahead and do that now. Let me do this. Oh, there you see my stock listing there. That's not what I wanted. Here we go. We're going to talk about debt and why we're going to go there. And it's going to be more than just debt. But that was kind of the tag to kind of, give us an idea of what we're going to be talking about tonight. So first of all, in the questions for Kevin that came out of the Discord, here it is from Nkiter. And I don't remember, there was a couple of guys in the Discord talking about Hershey and debt levels and EBITDA. And so they kind of put all of that together and put it in a question. So I'm going to read the question, and then I'm going to kind of walk through this backwards, okay? He says, out of curiosity, can you elaborate on your investment thesis on Hershey? And the answer is yes, I can do that. Has forward PE higher than current PE, which is the first sign that they expect lower earnings, and that is absolutely correct. They do expect lower earnings. Having that big chunk of debt for their net income, it will take them 4 to 5 years to pay off. Okay, so that kind of gets us into this debt discussion. And then he says the common practice is to measure the long-term debt against EBITDA to be less than 3, not against net income. And I think what this was part of the discussion that they were, talking about debt compared to net income versus debt compared to EBITDA. I don't even look at either of those metrics. I don't think that they are worthwhile to look at. I will tell you what I look at in terms of debt. But so we're going to talk about things in a little bit reverse order. I want to talk about debt first. How should we think about debt? How should we, as investors, think about debt and the companies that we're investing in? Secondly, I want to talk about EBITDA. What is it for? Why would we use that? EBITDA stands for earnings before interest, taxes, depreciation, and amortization. How did it come about? Why would we even use that? And then lastly, I want to follow up with my thoughts on the investment thesis for Hershey's. Now, I will tell you, I put these slides together yesterday, and there was some news about Hershey, or rumors, I guess, more than news, about Hershey today. So we'll talk about that at the end, but I don't have any slides on that. We'll just have to kind of look at it. All right, so you guys ready? Get your seatbelts on? Let's do it. All right, so capital structure. One of the things that I see and I hear a lot in my dividend, when I listen to YouTube, all of my friends that are dividend investors, they talk about debt and they really want companies with zero debt. And that's a good thing, right? I mean, who can argue with having no debt? I mean, I think even, from a personal perspective, having zero debt is a great place to be. It kind of helps you sleep at night. The grass feels different under your feet when you own your home. So there's just some good things about being debt free. But I wanted to share with you that from a business perspective and as a shareholder, maybe it's not always best for your companies to have zero debt. So I wanted to share that and the logic behind that. You can make whatever decisions you want, but I just want to make sure that everybody understands from a capital structure. Does everybody understand what capital structure is? Capital structure is how is the business capitalized? You can capitalize, we'll simplify it. Well, you can capitalize a business with equity, which means owners are putting money into the pot, and you can fund your investments with debt. So you can have debt or you can have equity. There's some other stuff, but I think just from to make it simple, let's just say that there's debt and there's equity. That is the capital structure. So you can have all equity, or you can have mostly debt, or you can have some mix between the two. Is it bad for a company to have a reasonable amount of debt? Let's kind of walk through an example. I put together this example. So should a large project, let's say that the company is already going, right? And it's already got its structure. And right now, the company has $100,000 of equity, let's say, and this is just all made up, right? But let's say that they have $100,000 of equity, no debt. They have 1,000 shares, so their equity per share, this will be their book equity per share, is $100 per share. So life is good, but all of a sudden they've got this huge project. Maybe it's building a new plant, and they're going to spend $200,000 on that. Maybe it's acquiring a business. There's some opportunity they have that's going to cost them $200,000, but their potential annual return is 20%. They've done the work. They've forecasted out. They predicted their sales. They predicted their costs. They've looked at their supply chain. They've calculated their risks. And out of all of that, they've said, you know what, we can generate 20% return if we invest this serious amount of money, because remember, it's double their current equity. So it's a big deal, right? So they've done all their homework. They've looked at debt costs, and let's say that their debt is going to cost them 7% per year. The bank has said, hey, we'll loan you money, but it's going to be at 7%. So there's three options they have. They can either do it with debt only. They can do it with a combination. I just did 50-50 debt to equity, or they can do it with all equity. And I wanted to show you what the impact is on the shareholder for each of these options. So if you look at option number one, they fund it all with debt. Now, we're going to talk about, there's got to be a reasonable level of debt here, but just for this example, I wanted to show how big of an impact this could be, right? So if they're going to pay 7% in debt cost and they're making 20% on the project, that leaves 13% of the value of the project each year to go to the shareholders. So if they said, hey, bank, give me $200,000, they put that in, and so they pay, the project gives them $40,000, which is the $200,000 at 20%, gives them $40,000. They pay 7% on the $200,000. That's going to be $14,000 per year in interest. The net of that is $26,000. They did not issue any equity for the project in option one. So they have the current shares, which are 1,000. That gives them a shareholder value impact per share of $26. Okay. So again, this is not changing anything about the project or debt or anything. It's simply the capital structure, okay? Option number 2, they're going to go 50% debt, 50% equity. That means that 100% is going to be debt, 100% or 100,000, I'm sorry, is going to be debt, 100,000 is going to be equity. They're still going to get 40,000 from the project, but now it's only going to be $7,000 in interest, right? Because it's 7% on 100,000. And I keep trying to knock my water bottle over. But that leaves $33,000 for shareholders. And you think, oh, that's a better deal. However, if it's still the same book value per share, $100,000 in equity is another 1,000 shares that they would actually issue. So you're going to have the cost of the project, or the value of the project, which is $33,000, divided by the total new shares of 2,000. You're ending up with $16.50 per share. You go all equity, then you have no interest expense. You get the $40,000, but now you've got 2,000 more shares. You started with 1,000, you got 2,000 more. Now you have a total of 3,000 shares. You got $40,000 of value from the project, 3,000 shares outstanding. That gives you $13.33 per share. So the question is, what would we want to do as shareholders? We, without any other thoughts, we would say, let's borrow all the money because it gives us as shareholders more value. So hopefully that makes sense. You get more value per share if you borrow the money, because you're not going to borrow the money if you can't make at least some return on top of the interest, right? So if we can kind of come to that conclusion, if they were going to spend money on a project and it did not add any value to the business, I would wonder about the management team and why they made that decision, right? So let's assume that it's going to be higher than the cost of debt. The value that the project brings is higher than the cost of debt. So we want them to borrow all the money. Why is that? Because we don't really want them adding equity. So if we look for companies who only have equity that have no debt, then we've taken the value that the business brings and we spread it over more shareholders. And the shareholders get the equity returns, which theoretically include the risk of being owners of the business. The debt holders get their 7%. That's it. That's all they get. If the business makes 20% on the project, they still pay 7%. If they make 30% on the project, they still pay 7%. If the project flops and they make 0, they still pay 7%, right? So that's the idea here, is that if here, let me just kind of go to the next screen here. Takeaways. Companies can maximize shareholder returns by carrying reasonable amounts of debt. So if they don't carry any debt, then you're sharing every dollar of profit with all the shareholders. If they carry a level of debt, then you've got some interest expenses. I just noticed that honeybee's still on there. Then you've got some interest expenses that are going to be that are going to be paid out of the value of the project, but the shareholders get the rest of it, right? So the fewer shareholders you have, the fewer equity, the less equity you have, the more benefits are spread to a smaller pot of shareholders. Hopefully that makes sense. If a company, this is number 2, if a company has no debt, it may be the most expensive capital structure for the investor. Maybe not the business, but for the investor, it may be the most expensive capital structure. So let's say a business doesn't pay any dividends, then for the business itself, it might be a cheaper cost of capital structure. But for the investor, if they do a project and they're going to issue equity every time they do that, then you're going to be spreading not only the new value, but also all of the existing value. You're going to be sharing that with additional shareholders. Not exactly the best solution, I don't think, for investors. So number 3, no net debt. significantly reduces the risk of bankruptcy. So, so what's the positive here? If there's not a debt holder, then the odds of bankruptcy go down significantly. I mean, there are some other things, like maybe government taxes or something like that could force a company into bankruptcy. But if they don't have debt holders, which means they don't have bonds, they don't have any debt instruments at all, the likelihood of them going into bankruptcy is pretty small because there's nobody to push them into bankruptcy. They don't owe anybody anything. So the positive side is they don't have a risk of as much of a risk of bankruptcy. The bad or the downside is the investor doesn't get a maximized return. So there's that. So I think from a debt perspective, I think it's good for companies to have a reasonable amount of debt. Now, I say this kind of in a vacuum here, because if a company has a large amount of, let's say this, if a company has a lot of cash and they, let's take Microsoft, for example, Apple, companies that are just flush with cash, I think that's fine for them to not have any net debt. But you've got other companies who are capital intensive. They're not flush with cash. And I think having a good balance between debt and equity is a good way of managing and maximizing potential returns for investors. So I would not ignore companies who have levels of debt. So we'll talk here in a few minutes about what is a reasonable level of debt and how do we measure it, right? So let's go ahead and go on to EBITDA. And before I do that, I'm going to get a drink because I didn't realize how technical this was going to be. EBITDA, earnings before interest, taxes, depreciation, amortization. Just a few things about it. During the 1980s, the investors and lenders involved in leveraged buyouts, what we called LBOs at the time, found EBITDA useful in estimating whether the targeted companies had the profitability to service the debt that was expected to be incurred in the acquisition. EBITDA is a non-GAAP measure, so similar to normalized earnings for earnings per share. EBITDA is a non-GAAP measure. The SEC requires listed companies to reconcile any EBITDA figures they report with net income. And this is important, it bars them from reporting an EBITDA per share. The Financial Accounting Standards Board, FASB, has determined that this EBITDA per share figure could be very misleading to investors. So therefore, it bars companies from reporting an EBITDA per share. Operating cash flow, in my opinion, is a much better metric. Obviously, EBITDA ignores depreciation and amortization as well, but it also pulls out income taxes and interest. But, operating cash flow also pulls out depreciation and amortization, but it also includes things like working capital, accounts receivable, payables, inventory moves, things like that. You get a much better flavor for the operating business, in my opinion, if you use operating cash flow. Not a fan, personally, I'm not a fan of EBITDA. References to EBITDA make us shudder. This is from Warren Buffett. I think it was the 2000 annual report for that Warren Buffett put out. He's pointing out that depreciation, for instance, that is ignored in EBITDA is a meaningful measure of performance. Charlie Munger said EBITDA is bull bleep earnings. So, I'll let you kind of fill that gap in. So anyway, Warren and Charlie are not fans. I'm not a fan of EBITDA. So I think I've said enough about EBITDA. Let's move on then to Hershey. And remember, I did all this yesterday. I thought what we could do, I want to move this over here. And let's go back to this real quick. I'm going to review things like the payout ratio, earnings per share, all that stuff, and then talk a little bit about Hershey. So let's go. Oh, there we go. Let's go to Simply Safe Dividends. We'll log in there real quick. We will go to HSY. And, just for full disclosure, I think I'm somewhere around 3% of the portfolio is Hershey. Yeah, there it is, 2.9%. Let's see, is there anything important in here? Let's go down to the metrics. Let's go down here. Let's look at the payout ratio for Hershey. So you can see here that it's been, pretty steady, in the low 50s, mid 40s. All of a sudden here, it's gone to 61, 66%. That's the indication of the issue that we've got with Hershey. Although free cash flow payout ratio doesn't look as bad. Earnings per share, you can see it trailing downward. They've been buying back some shares. I think that will slow down. Sales look like they're going to trail off a bit. Some of my favorite metrics: return on invested capital, in the mid 20% range. That is actually really nice. That's part of the thesis behind it. Now, what I look at, and this is what Inkider was talking about, net debt to EBITDA. There's, some look for 3, some look for 4. Simply Safe Dividend looks for it to be 4 or below. But, for Hershey, it's down in the 1.74, 1.78 range. So very manageable level of debt. When I look at their net debt to capital, Simply Safe suggests below 65% debt. I like it to be more half and half, 50-50. So they're trading somewhere around in a 54% debt to capital. So 54% of their capital structure is debt and 46% is equity. That to me seems reasonable. That's the metric that I look for to see if a company has reasonable debt. The other thing I look at is the interest coverage ratio. That lets me know whether the company's producing enough income to pay the interest on the debt. 8 is a good level for that. You want it to be higher than 8. And, for Hershey, it's around 14.5. So, from a financial perspective, Hershey looks fine. So, I'm going longer than I thought, so I'm gonna pass on the fast grass thing. But just to tell you that I believe Hershey has a solid management team, solid balance sheet, iconic brands. Their main issue is supply. The supply of cocoa is struggling, and it is not an easy fix. So they only have limited pricing power. So as the cost of cocoa goes up, they've tried to raise prices, but they've really struggled getting those prices up. And so there's a bit of a challenge there. It won't be solved quickly, but I believe it will create a tailwind when they are able to solve the supply problem. And it's not going to be something that Hershey alone solves. It'll have to be the entire cocoa industry. Some final thoughts on it. Friends went to Hawaii for a second time, and they visited some fields that had previously been planted with pineapples. And guess what they saw growing in those fields? And just guess. Tell me what you think they saw growing in those fields. I'll look for your, I'll go ahead and move forward, but I want to see if you can tell me what they're growing now. Supply recovery will be slow. And remember, this is after today's rumors, but I said, hey, DCAing into Hershey for the next few years could be a winning strategy. Hershey's debt level is manageable, helps maximize shareholder return. And Warren Buffett once said that it's wise for investors to be fearful when others are greedy and to be greedy when others are fearful. I think up until today, people were fearful of Hershey. So, and my buddy Michael might be the only one still awake after this discussion, but he says cocoa beans, and you are right, my friend. They have replaced pineapples in some of those fields with cocoa trees that produce cocoa nibs, right? I think that's what they call it. And inside there are is the cocoa. So yeah, I think there's going to be solutions kind of outside the box on this. Now, granted, it has to be a certain climate to grow cocoa, so you can't just grow it anywhere. But Hawaii seems to be pretty reasonable for that. Okay, so back at the ranch. Back at the ranch. What happened today? Today, Hershey, there was some rumor that Mondelez is wanting to make another bid for Hershey. I think back in the 2016 timeframe, they tried to acquire Hershey. And so there's rumor that Mondelez wants to make another shot at that. Will it happen? I don't know. I don't know. I do know that there are some big hills for them to climb, Mondelez. And one of those is that 80% of the voting rights for Hershey is held in the Hershey Trust. Hershey has a capital structure that has voting shares and non-voting shares, and 80% of the voting shares are held in the Hershey Trust. So it's not like they've got to go out to all the investors. It's that they've got to convince the Hershey Trust that this is the right thing. There's also some special laws in the Commonwealth of Pennsylvania. So they've got to work through that. And there's one other thing, I can't remember what it is. So they've got, it's going to be a pretty big hill to climb. But even just the rumor sent the stock up today, like 10, almost 11%. So what's my thesis for Hershey? First of all, their issues have nothing to do with production, has nothing to do with management, has nothing to do with strategy. It has everything to do with supply. And once they get that supply rectified, but it's not going to happen overnight. It's got to be fixed over time. And but I do believe, and it's not just a Hershey issue, it's an industry issue. However, most of the like M&M Mars, I think even Nestle are private companies. So you don't see that in their stock price because they don't have a stock price. So I could be wrong on Nestle, but I know M&M Mars is private. So I believe that in the long run, Hershey will get this figured out, and then their prices are going to be elevated, and their costs are going to be coming down. And they may bring their prices down a little bit, but they're going to keep some of that margin. So I think in the long run, it works out for shareholders, and I think we recapture some of the undervalue, and I think they're going to grow the business faster, in those out years than what we're expecting. So that's my thesis around Hershey. Whether it works or not, I'm not really sure. But let's take a look and see. So cocoa beans was right, Michael. I appreciate you bringing that up. Let me get caught back up here. Let's see. Well, she knows an undervalued growth stock now. Yep, that's right. That is definitely one of my undervalued stocks for sure. Yeah, good thing I didn't ask about Siri. That's right. Or my phone would have gone crazy. Ex-Dividend Dad is here. Welcome, my friend. Good to see you on the program tonight. A lawsuit judgment could force a bankruptcy. Yeah, because there would be an obligation, right? So that is absolutely true, and we've seen that many times. Well, we saw it in Johnson and Johnson, right? They even created a company to cause the lawsuit to drive into bankruptcy, right? So that's right. So not only so you need somebody that you have an obligation to pay to force you into bankruptcy, and a lawsuit is one of those things that would do that. Mondelez exploring takeover. Yes, that's right, Steve. It is Mondelez. I used to call it Mondelez, and I was corrected. So Russ Moments is here. Good to see you, buddy. Cocoa beans. How many years before you get cocoa beans from a cocoa tree? That's a great question. My understanding is it's probably 5 years. But it's not just that they don't have enough cocoa trees. I think they had weather issues. Their crops just have not been what they wanted them to be. I'm not an expert on cocoa beans, but I do believe it takes about 5 years to get a cocoa tree to be producing cocoa beans. I could be wrong, but that's what I understand. If it remains independent, Hershey should secure its own supply of cocoa trees. Yeah, that's a good thought. It's called vertical integration, right? So if a company wants to be vertically integrated, they will take over each facet of the supply chain, and that way they would have their supply. The challenge is that there's only a few places in the world that grows cocoa, and one of those is the Ivory Coast in Africa. There's another one in South America. I don't recall exactly which country it is. Argentina, Bolivia, Colombia. I'm not really sure. Somewhere down in there is another area. Obviously now Hawaii. Maybe there's some other islands, Caribbean islands that might be worthwhile. But I think Hershey has taken a stance as a management team that they are going to use the cocoa market to buy their cocoa, and my assumption is it takes an expertise to grow cocoa, and they have the expertise in manufacturing, distributing cocoa products. The chocolate bars, but they don't really have the expertise to grow the cocoa. And so that would be one reason they might want to stay out of that business and just use their influence to get the cocoa trees out there. But, it's certainly a discussion, I think, for the management team and board to have. Let's see. On Hershey and Mondelez, what happens to the stock if they do a merger? Well, so first of all, there's as far as I know, there's no official bid. But my understanding, and it's all speculation and conjecture. So just take it for what it's worth, right? If Hershey were to be acquired by Mondelez, then Mondelez would either issue shares or issue debt to raise the money to buy the shares of Hershey. And so if they did shares, they would do a trade, right? They would give you so many shares of Mondelez for so many shares of Hershey. Sorry. And if they raise the cash, then they would give you so much per share for Hershey. But I don't know how they might do it if they were actually to make an official bid for the company. I think that's what they would do, and it would end up being a part of Mondelez. It would be, it'd be called either an acquisition or a merger, but I doubt it would be a merger of equals. I think Mondelez would be bigger, and so the merger would fold Hershey into Mondelez. That's the way I think it would happen. McDonald's supplies all its own eggs. Are you sure? I'm not aware of McDonald's owning an egg supply. They might, but I know that Cal-Maine is a huge producer of eggs. I know a farm in Alabama that has 10 chickens on it that has eggs. But yeah, I didn't know that McDonald's supplied its own eggs. I would be surprised. But you might be right. I don't know. I'd have to look into that. AES. Yes, a utility. Oh, yeah, I've got that on my list, Steve. I think you asked for that a little bit earlier. We'll go through this one question from John, and then we will hit these two things, Civi and AES. I'd like your thoughts on Celsius Holdings, CELH, for the long term, eating away at Monster and Red Bull, Pepsi behind them as a distribution, with distribution partnership, potential takeover. Yeah, well, I'll look at that. I'm not familiar with them, but I'll give you any thoughts that I have. Okay, so we'll look at these three. Let's see. Fast Eddie says he wishes he owns the parts supplier for their ice cream machines. Yeah, absolutely, man. I don't know if they are always broken. I just don't think they want to clean them. And so therefore they say they're broken. That's my thoughts on it. So yeah, it might be true. Let's look into that. I don't know. I'm not even sure how to look into it, to be honest with you. I'm not sure that they would even say. But it's an interesting question. I didn't realize that they owned their own egg facilities, if you want to call them that. So, all right. So let's take a look. Let's switch then over to all right. You guys hang with me here. We're going to hit this again. We're going to look at Civi, CIVI. CIVI. Civitas. It's an oil and gas exploration. Has no rating from Simply Safe Dividends, which likely means it doesn't pay a dividend. It focuses on acquisition development, Rocky Mountains. So it has. It started a dividend back in 2020. It has grown significantly fast over that time frame, 21%. That's really good. Although it looks like from 22 to 23, it only went from 46.25 to 50 cents, and it's been that way for at least 9 quarters. But they've had some big payouts on special payouts, so that's good to see. And that's kind of the way I would like oil and gas to do, is based on their profitability, that they would pay their dividend out. I think that makes more sense for their business. But they've been issuing a lot of shares, man. Return on invested capital is not that great. It's 11%, 14%. Net debt to capital is in that 42% range, so that seems to be reasonable. Although their interest coverage is only 4.01. So what does that mean? It means that they are a little below my expectations for being able to cover the interest expense based on the earnings of the company. I don't know. Let's see if Morningstar has. I doubt if they do, but let's see if they've got a fair value for them. No, they don't. They say it's around 82, so it looks to be it's 82 is the fair value, and the price is 47, and they say it's fairly valued. So seems to be about. But I think the point is that this Q rating here is quantitative rating, and I just don't trust them. I don't think Morningstar does either. So that's why they're saying it's not undervalued. It is fairly valued. But if this is something that you want to get into, I would want to know where they're drilling, what they're able to get to, what they have rights to. There's a lot to think about in terms of an investment like this. And I don't remember who asked for this, but that's kind of, those are my thoughts on it. So I think I would be kind of lukewarm on this. I would say it needs to have some more due diligence. AES is an independent power producer, and it has a 49 dividend safety rating. Let's see how they're doing here. Payout ratio is 30%. That's not terrible. Their latest dividend increase was just here recently, December of 24, at 2%. And over the 5-year period, it's 5%. Last 10 years is 15%. So you can see from 2011 to 2015, it grew significantly. But since then, it's only grown at about a 5% pace. It has slowed to a 2% pace. Let's take a look really quick at their ratios. Payout ratio looks fine. Free cash flow ratio for utilities is not a metric that makes any sense on any utility. So I passed that up. It's not even worth looking at. Earnings per share looks like they're gonna. They had a blip, or I don't know, opposite of a blip. It's a spike in 2024, and looks like they're going to go down a little bit in 25. Return on invested capital is probably normal for a utility. They typically don't have a large return on invested capital. Their net debt to capital is 77%. I think that's a little high for utilities. I know they say here 0.4 or more, but for utilities, it's usually probably in the 0.6, 0.7 range. But I think this is still even a little high. Their interest coverage ratio is pretty low as well. So I'm not a huge fan of AES. I think there's better utilities out there. I think, their dividend yield is 5.18%. That's probably what is attractive about them. But if, for instance, I'll just throw out Wisconsin Electric, WEC. They're only at 3.68%, but they've got a much better balance sheet, much better. Their financials are better. Let's see what their payout ratio is relatively high, but that makes sense. Return on invested capital is around that 6%. That's kind of what we talked about. Net debt to capital is in that 0.6 range versus 0.77 range. So I think an interest coverage is about twice as good as the AES. So I think there's some better utilities out there. I think WEC probably is the best value right now in the utility space, at least the ones that I cover. But, each to his own, said the lady should kiss the cow, right? So, and then the other one was, I don't know if CELH. Let's look at that real fast. So we'll do that, and then I'll tell you about what my plan is for the rest of the year. So Celsius Holdings, not much out there on it. Let's see if it's got any fair value from Morningstar. Yeah, $32.50. Its price is $30.56. So it's in a fair value range. Very high uncertainty. No economic moat. So yeah, it's not anything that I would be interested in personally, but if that's something that floats your boat, sometimes we got to enter into some speculative investments, right? It's about where we want to grow the portfolio, the amount of risk you're willing to take. So if you're willing to take on a lot of risk and, you're willing to kind of take a gamble on it, I think it possibly could pay off. The return on invested capital is all over the place. Negative, positive, negative, positive. It's headed back down again. So, I don't know, man. Net debt looks okay though. Net debt to capital. So yeah, I don't know. That's not something that gives me a lot of excitement. So there's that. Let's see what else we got here. John Jay says that Campbell Soup grows their own tomatoes. I don't know, man. We're gonna have to check all this out. I'm not sure how to check on supply chains. I know that Del Monte grows a lot of tomatoes. I'm not sure. I don't know that I have ever seen a Campbell's tomato farm. And I've traveled in Mexico, Guatemala. Um, I've seen Del Monte stuff, but I've never seen Campbell's growing tomatoes. But it could be. Uh, so Walmart drives their own trucks. So does Amazon. Um, I think I think their drivers are contracted, if my memory's right. But I mean, you could be right. I don't know. We're talking about details that I just don't know. Del Monte also grows their own bananas. That's right, and so does Chiquita. Chiquita Bananas. Chiquita is not a separate company anymore, I don't think. So, okay, so here's the deal. And I'm gonna share. I'm gonna share with you. Let me come back to this here. I'm going to share with you kind of where we are. This is the spreadsheet that I use to determine what to buy. This morning, before the market opened, Hershey was the number 3 stock in the list in terms of what to buy. After today, it has grown by 10.85%, and it is now the 9th ranked stock because I've got a header line in here. It is the 9th ranked stock. So it made a big move. That's a big move for this model. But that's not what I want to show you. Here's what I want to show you. We have year to date through today seen a growth in the portfolio of, here, let me highlight this, $295,917. So roughly $300,000 of growth in the portfolio. So my wife and I decided last night that we are going to, one of the things we like to do is give, bless others based on how we've been blessed. So we are going to take some of that money and actually give to our church, give us some things that have value and meaning to us, as well as we also give some to our kids each Christmas. So if you have not thought about, and I mean, and some of you are younger, which means you don't have access to after-tax funds. Obviously, these would have to come from after-tax funds. But if you are at a place where you're kind of living off your portfolio, and it really provides more above and beyond, consider causes that are really important to you and giving. Because I will tell you, it is. I don't know, what's the old saying? It's more blessed to give than to receive. That is not a biblical reference. I don't know where it came from. I think maybe it's Ben Franklin that said that. But there is just something about giving. And so, if we hold everything so tightly, then we just become the wrong kind of people. But as dividend investors, one of the things we want to do is also to give. And so in this season of giving, I would just encourage you to take a look and see if there's something that you want to give to. So in order to give, guess what? I had to sell some stocks, and nobody has guessed. Nobody has guessed what stock I sold out of. Anybody got any last minute guesses on that? We've got about 40 seconds. No, I'm sorry, 20 seconds left in the broadcast. And I want to share with you what I sold out of. APD? No, I did not. That's a good question. So let me kind of preface this by saying it had to be in my after-tax account because I'm still not 59 and a half. So if I were to sell something out of a tax-favored account, I would end up not only owing the tax but also the penalty. So Lamb Weston, that's a good guess too, Rust, but I did not. That's also in my rollover account. Billy gives all year long in the Philippines. It's easy to do. Absolutely, my friend. And, I'd like to learn more about what you do there in the Philippines, Billy. Maybe we can connect somehow offline and talk about what you do there and, see if it's something we want to get involved in as well. That's good stuff, man. You are a good man. So any other guesses real quick? I don't see any. It's not on there anymore. So I will tell you. John says Hershey. No, I did not sell Hershey today. Unfortunately, I didn't sell it on Friday. That would be the normal for me. I would sell out of it on Friday, and it pops by 11% on Monday. But I did not. I held on to it. And actually, what I sold is United Parcel Service, UPS. And it has basically been floating around. If I were to look at, as you guys know, I track the historical performance of all my stocks, everything that I've invested in since 2021. And on the whole position of UPS, I lost $16.87, but I needed something to liquidate, to sell, to give some money away. So I sold out of that, and I sold a few shares of one that we talked about last week, which is Pinnacle West. That is also sitting in my after-tax account. So I sold out of UPS. I sold some shares of Pinnacle West. And we're going to take that money, give it away, and just, enjoy that. I think there's just something about, they call money currency, right? Because it has a current. It's the wealth circuit portfolio. A circuit has a current running through it. And it's not that all the money would come in and that we wouldn't use it to bless other people. It has to flow. It's got to be a current. It's got to be flowing. And I just think that's the right way to live. So if you're considering that, I would highly recommend that you just make it happen. Doesn't have to be a lot. Just start small but just give. Give to. We're going to give to our church, but we're also going to give to some other people. And I think that's going to be fun. I think we're really going to enjoy that. I don't like to talk about that too much because, it makes you think you're kind of boasting a little bit. But the reason I'm talking about it today is I just want to put that in all of our minds at this time of the year, that if you've got an opportunity, if there's a need out there, if there's some cause that you're passionate about, consider giving to it. I think it will kind of put you in a different frame of mind, put you in a different place. And, it's not always about just growing the portfolio. It's also about using it to bless others. And so with that, I'm going to let you guys go for this week. My voice actually almost lasted the whole time. I'm on my third round of antibiotics, and I think this is really going to work. So I'm looking forward to that. So with that, my friends, it has been a pleasure. I've enjoyed this week, and I hope you guys will be on the stream next week. The next week will be the 50th one, so I'm hoping that we can get the Ryan, Russ, Kevin trio together and have a real fun discussion next week. If not, it'll be soon, but hopefully it'll be next week. So with that, guys, I'm going to get off here. I will talk to you on the next one.